Welcome to vTalkInsight, Market Drivers Daily for March 2nd, 2026. A fast-spreading Middle East war has fused energy security, inflation, and central bank expectations into one story. Oil, gas, equities, bonds, and currencies are all reacting to the same question. How long does this disruption last? Let's begin with how the geopolitical shock is reshaping the global risk backdrop. Regional tensions have broken out into a broad Middle East war involving the U.S., Israel, Iran, and around a dozen countries, with no clear path to their escalation. Washington has launched a large, multi-domain campaign designed to cripple Iran's missile, naval, and nuclear capabilities, while Tehran has rejected negotiations and continues to retaliate across the Gulf. Only a few days ago, markets were mainly assigning probability to a potential Strait of Hormuz disruption. That tail risk is now much closer to the center of the macro narrative. The result is a war premium that is increasingly driving energy prices, inflation expectations, and the trajectory for policy rates. On the ground, attacks on critical energy assets are translating directly into price action. A drone strike has shut Saudi Arabia's Ras Tanura refinery, and major facilities in Saudi Arabia, Qatar, and the UAE have paused operations for safety reasons, taking millions of barrels of crude and products offline. Tanker traffic through the Strait of Hormuz has almost stopped as insurers pull war coverage, putting roughly one-fifth of global oil and liquefied natural gas flows at risk. Brent has posted its largest one-day rally in nearly 4 years, with gains in the high single to low double digits, while European gas contracts have jumped between about 20 and 50% on supply fears. These commodity moves are feeding directly into risk assets and rates. Global equities are under pressure, with European benchmarks down around 2% or more and U.S. futures off over 1%, even as energy producers and defense names rally strongly. Gold is catching a bid and the U.S. dollar is firmer against the euro and sterling, reflecting classic flight to safety, but the bond story is more nuanced. U.S. Treasury yields initially fell on haven demand, then reversed higher as a very strong manufacturing prices index and higher oil revive inflation worries, pushing the 10-year back above 4% and lifting bond volatility above equity volatility. The key macro concern is that an energy shock arriving when inflation is already elevated could tilt major importers toward a stagflationary mix. Europe, the UK, and Japan are especially exposed, given limited domestic energy supply and rising natural gas benchmarks, while commodity exporters from Norway to parts of Latin America may see terms of trade improve. Markets are rapidly trimming expectations for near-term rate cuts from the Federal Reserve, the European Central Bank, and the Bank of England, as higher oil and gas complicate any pivot toward easier policy. At the same time, U.S. activity data, such as the latest manufacturing survey, remain resilient, suggesting that for now the shock looks more like an upside risk to inflation than an immediate hit to growth. There is, however, a counter-narrative that limits how far this war premium extends. Some analyses highlight ample non-Middle East supply, including from North America, relatively healthy global inventories, and the fact that despite dramatic headlines, oil has not yet moved into the kind of parabolic spike associated with past crises. Credit markets, including leveraged loans and high yield, have so far seen only modest spread widening, and Israeli assets and the shekel have shown surprising resilience, implying expectations for a contained conflict. Going forward, the market's pricing of energy and rates will hinge on how long tanker traffic remains constrained, whether further large refineries are disabled, and how central banks respond to any sustained overshoot in inflation data. To gauge those probabilities, it helps to look more closely at how the conflict itself is evolving. The military picture has moved from discrete strikes to a multi-front regional war. U.S. and Israeli forces are conducting an intensive air and cyber campaign against more than 1,000 Iranian military targets, aiming to destroy missile launchers, naval assets, and underground nuclear facilities and to secure air superiority. At the same time, Israel has opened a northern front with Hezbollah, evacuating dozens of villages in southern Lebanon and stepping up airstrikes, while mobilizing around 100,000 reservists and disrupting domestic economic activity. Official rhetoric from Washington stresses limited, tactical goals rather than regime change, but the stated willingness to sustain operations for weeks keeps the horizon for the escalation very unclear. On the Iranian side, capabilities are being eroded but not eliminated. Estimates suggest ballistic missile stockpiles have fallen sharply, with fewer than 1,000 medium and long-range missiles still available, which could cap the intensity of salvos in coming days. However, Iran retains thousands of drones and is already shifting toward more drone-based attacks, particularly against high-value economic and infrastructure targets across the Gulf. Hezbollah and other proxies still field substantial rocket and missile arsenals, but assessments indicate they are only able to mount nuisance attacks rather than fundamentally alter the balance of power, given the scale of U.S. and Israeli air dominance. Politically, the regime in Tehran remains cohesive despite leadership changes and the loss of control over key parts of its airspace. The Revolutionary Guard and associated security forces continue to suppress dissent, and succession plans appear prearranged, which limits the odds of an immediate collapse even under heavy military pressure. That said, the regime is clearly weakened. Its regional relationships with Gulf neighbors have deteriorated, and markets are watching closely for any signs of mass protests or defections that could signal a shift toward internal power struggles. In one long-term scenario, a transition away from the current system could eventually improve regional stability and lower the geopolitical risk premium embedded in energy, but that path is highly uncertain and unlikely to be quick. For markets, the crucial variable is not just who gains the upper hand militarily, but how long active hostilities and high headline risk persist. Some strategists argue that unless oil prices stay elevated for an extended period, the conflict may rhyme with past episodes where equities ultimately recovered once the shooting started and uncertainty about the immediate worst case faded. Others stress that today's backdrop of already tight labor markets, sticky inflation, and stretched valuations makes the system more sensitive, so prolonged conflict could lead to deeper and longer-lasting equity weakness than history might suggest. What is clear is that correlations across assets are rising and options markets show heavy demand for downside protection in broad equity indices alongside upside in crude, consistent with expectations of elevated volatility. Several battlefield indicators will shape that debate over duration. The pace and accuracy of missile and drone launches from Iran and its proxies, the effectiveness and cost of air and missile defense in the Gulf, and any expansion of attacks on civilian targets, such as airports or financial hubs, will all influence perceptions of escalation risk. So will U.S. casualty numbers and any move toward ground deployments, as well as diplomatic initiatives from Europe or China that could create an off-ramp. Taken together, these factors will determine whether the conflict remains an intense but time-limited air campaign or morphs into a more open-ended confrontation, which in turn sets the backdrop for how energy and risk assets trade from here. That brings us to the third dimension of this shock, the physical disruption of supply chains. The most acute supply chain stress today is concentrated in the Strait of Hormuz and surrounding energy hubs. War risk insurance for ships entering the Persian Gulf has been withdrawn or repriced sharply higher, effectively closing the strait to most large tankers even without a formal military blockade. As a result, tanker traffic has nearly halted, idling dozens of very large crude carriers and putting roughly 20% of global oil and liquefied natural gas exports in limbo. Qatar's decision to halt all liquefied natural gas production after drone strikes on key facilities has temporarily removed an estimated 20 to 30% of global LNG supply, driving European gas benchmarks up by around a quarter to one-half and sending UK gas even higher at the open. Air transport is experiencing a parallel shock. Airspace closures across the UAE, Qatar, Kuwait, and Bahrain, along with shutdowns or severe restrictions at major airports in Dubai, Abu Dhabi, and Doha, have triggered unprecedented global flight cancellations. Hundreds of thousands of passengers are stranded, and airlines face logistical challenges repatriating crews and aircraft, with sector losses expected to run into the hundreds of millions of dollars. Airline and travel stocks are among the worst performers, with some European carriers down close to 10% as they absorb higher jet fuel costs, rerouting expenses, and collapsing demand on Middle East routes. Beyond the immediate headline numbers, the conflict is accelerating a broader rewiring of trade routes. Shipping insurers' retreat from Gulf coverage and sharply higher premiums are pushing cargo owners to seek alternative corridors, adding cost and time to Asia-Europe trade that traditionally relies on Middle Eastern hubs. Even before this crisis, governments and companies were investing in the so-called middle corridor that bypasses Russia and in new infrastructure and resource access across Central Asia and the wider region as a hedge against geopolitical choke points. Now, with commodity hoarding by large importers such as China and India expected to intensify, the incentive to diversify sourcing and logistics away from single points of failure like Hormuz is likely to rise further. These supply chain strains reinforce the macro picture of higher costs and uneven regional impacts. Energy importing economies in Europe, the UK, and parts of Asia face renewed pressure on growth and inflation as gas and shipping costs rise, while producers such as Norway or certain Latin American exporters benefit from stronger pricing and improved external balances. Equity markets are reflecting this divergence, with European indices underperforming U.S. peers in sectors like energy, utilities, and defense outperforming travel, luxury, and banks. So far, corporate commentary suggests many firms remain operationally resilient, helped by prior experience with supply shocks and greater use of hedging. But guidance over the coming weeks will show how much margin pressure is building. The outlook for supply chains hinges on a few concrete milestones. One is the timeline for restoring safe passage through the Strait of Hormuz, whether via improved air and naval protection or a political arrangement that allows insurers to return. Another is the restart schedule for Qatari LNG and key Gulf refineries, which will determine how long gas markets in Europe and Asia remain on edge. And finally, the speed at which airspace and airport operations normalize will shape the duration of the hit to aviation, tourism, and high-value trade flows. Together, these factors will tell us whether today's disruptions remain a sharp but temporary shock or evolve into a more structural shift in how global supply chains and energy trade are organized. Across all asset classes, today's moves reflect one core question. Is this a short, intense shock or the start of a longer regime of higher geopolitical and energy risk? Current pricing points to a drawn-out but contained conflict that keeps a premium in oil and gas, lifts inflation risks, and nudges central banks toward a slower path to rate cuts, without yet signaling a deep global downturn. Watch for changes in the pace of attacks on energy infrastructure, the reopening of key shipping and aviation corridors, and any shift in central bank rhetoric around energy-driven inflation, as these will guide the next leg in equities, rates, and commodities. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.